Of the cornerstone investor concepts, there is one that is more decisive than all others in delivering a superior investment outcome. We think it's not an exaggeration to say that mastery of this one thing is the differentiator between a good investor and an average one. If our field was physical fitness, this topic would be eat well and exercise. And yet, this crucial concept is not only chronically misunderstood, but it may be one of the most unpopular, underestimated, and even underappreciated, perhaps loathed on occasion. Again, exactly like eat well and exercise, for most people, it is the thing that we know is very important but resist whenever we can. This pedestrian yet paramount principle is long-term versus short-term perspective. People struggle to internalize this concept because it's become exceedingly cliche, because it's vague, and because it's not the natural way most people think. It's hard while thinking in the short term is as easy as not even exercising. There's a distinction between long-term and short-term for investors. The challenges of adopting a long-term perspective, addressing the pitfalls of reacting to market events, and providing practical advice for overcoming short-term temptations and prioritizing long-term objectives. This is the third installment in my series of Investor Basics. Long-term investing focuses on a time horizon of several years, even decades, emphasizing growth and compounding over time. Investors with a long-term perspective are less concerned about short-term volatility and adopt strategy like factor investing, dollar cost averaging, and tax-advantaged accounts. Short-term investing, conversely, involves a time horizon of less than a year, aiming for quick profits through frequent trades based on market trends and news events. Short-term investors, such as day traders or swing traders, focus on immediate market fluctuations. In investing, long-term is typically seen as 5 to 10 years, allowing for smooth market fluctuations and compounded growth. However, it's more about intent and purpose than time. Long-term investing seeks extended growth, while short-term investing targets immediate market changes. Short-term market events can captivate and worry investors, making it challenging to adopt a long-term perspective. While long-term thinking might seem dismissive of short-term issues, mastering it is a significant advantage in capital markets. To succeed, investors need to understand the harm of short-term thinking and develop practices to counteract it. The peril of short-term thinking can lead investors to make impulsive decisions based on market events, which can be crippling to their investment outcomes. When investors ask whether they should make changes to their portfolio in response to news events, they are engaging in short-term thinking. This approach can result in missing out. Investors who attempt to time the market often end up missing some of the best performing days, when in fact missing just the best 25 days in the market over a 20-year period would reduce the overall return by nearly 80%. That's a very big return. Paying more. Frequent trading can lead to increased transaction costs such as trading fees and taxes, which can erode investment returns over time. Constantly reacting to short-term market fluctuations can lead to high stress levels, which can cause behavioral errors that degrade overall portfolio performance. This leads back to even more stress. Overcoming short-term temptations. There are many parallels between physical fitness and investor fitness. To prioritize long-term objectives and navigate the challenges of short-term thinking, consider these practical tips. 1. Be realistic. Recognize that adopting a long-term perspective is not easy or natural for most people. Understand that it takes conscious effort to resist short-term temptations and focus on your long-term goals. 2. Deliver a clear vision of the future you want. Set specific financial objectives and a time horizon for achieving them. Having a clear plan in place will help you stay focused on your long-term goals, even during periods of market volatility. 3. Ask yourself, how is worrying about what is happening today going to alter my goals and the planning I need to accomplish them? 4. Balance and moderation. Create a well-diversified portfolio tailored to your risk tolerance and investment objectives. Ensure that this portfolio contains sufficient liquidity and flexibility for the unexpected. This strategy will help you stay invested during market downturns and avoid the temptation to make impulsive decisions based on short-term events. 5. Establish a routine. Schedule periodic reviews of your investment portfolio, but avoid obsessing over daily or even monthly fluctuations. More frequent observations will not improve investment performance, but will increase stress, potentially leading to impulsive decisions and investing errors. Stick to your review schedule and resist the urge to make impulsive changes based on short-term events. 6. Seek professional advice. Working with a financial advisor can help you navigate the complexities of investing, stay focused on your long-term objectives, and avoid making impulsive decisions based on short-term market events. The good news is that, like exercising and eating well, maintaining a long-term perspective is only hard until it becomes habit. Indeed, the former is the defining trait of the healthiest people, and the latter is the essential view of most successful investors. The easiest way to start eating well is to stop eating badly. The easiest way to foster a healthy, long-term view is to stop consuming news that hacks our brains and keeps us fixated on the short term. You may have heard me say, the beginning of investing wisdom is the realization that long-term outcomes are the only ones that matter. This is true, but easier said than done. We are here to help you stay oriented towards long-term success, and we hope this has helped as well. Thank you.